All right, folks, welcome to Investing for Beginners podcast. Today we have our friend Pieter from Compounding Quality back to join us again. This is his third time with us. So Pieter, thank you very much for joining us all the way from Belgium today. We appreciate it.
Thanks so much, Dave, and nice to see you. And also nice to meet you, Andrew. Let's have a fun time over the next hour.
Yep, sounds good to me.
Down. Yep.
All right, so let's start with a nice, easy softball one. Your name is Compounding Quality, and you are one of the better stock investors out there. And so why quality? Why do you like that over, let's say, other styles of investing?
Well, it's true. So I started Compounding Quality in the summer of 2022. I needed to choose a name for my Twitter account, an anonymous Twitter account back then. And for me, it was quite easy. Thought about it for 30 seconds. Let's make it Compounding Quality. Why? Well, on the one hand, compounding, so the magic of compound interest. So I think everyone should invest in stocks because it's the best way to generate wealth for yourself, for your family. And on the other hand, quality, so let the magic of compounding work for you by investing in quality stocks. Like most investors, I made the move from value investing to quality investing over time. So from what Benjamin Graham did, like the book, The Intelligent Investor, that many of you will know, and then evolved more to what Terry Smith is doing right now, and actually also what Warren Buffett is doing as well. And what not too many people know, by the way, is I always say, well, I went from value investing to quality investing. But as a matter of fact, there was also a phase just before the value investing, or maybe at the same time, and it was quant investing, because when I was doing my local version of the MBA in Belgium, I live in Belgium, I actually wrote my thesis about quant investing. So I built my own quantitative investment method purely based on the numbers, and a computer could run it. And the goal then was to backtest that strategy and to see whether it worked or not. So that was a lot of fun. And I think the main key takeaway there probably is just there are multiple roads that lead to heaven or multiple roads that lead to Rome. It all depends on what you want as an investor. And I think you can borrow someone's idea, but never their conviction. So it's so important that you just pick a strategy that one, that works, and two, well, where you feel comfortable with, because if you don't, it will be very hard to pursue when things start to get tough. But for me, it is quality investing. It clicked from the beginning to just invest in the best companies in the world. And it's obviously a strategy that has worked tremendously well over the past 10 years, 20 years, 30 years. And hopefully, and I think it will, hopefully it will continue to do so.
So who are some of the practitioners that you kind of used as maybe your mentors to help you learn this style of investing?
Yeah, I think the beautiful thing in general is you can learn from everyone. You can even learn from people who have completely the opposite view and see whether his or her arguments to you make sense or not. But maybe to start with the general practitioners, well, I always say Warren Buffett is a quality investor, and most people think, look, he's a value investor. But if you read what he's doing and analyze what he's doing, well, even 50 years ago, he's using quality criteria, while the term quality investing didn't even exist yet. So I was looking at return on equity. He was looking at companies with plenty of reinvestment opportunities. So this year was my third year that I went to Omaha for the Berkshire AGM. Next year will definitely be my fourth year, even or despite the fact that Buffett won't be there. So that's one. Terry Smith, we also briefly touched upon from Fundsmith. Also there, I had the honor to have dinner with Team Fundsmith at Gorat's, so Buffett's favorite steakhouse in Omaha last year. So it was great to meet those people in person. And you notice there as well, one, they eat and breathe quality investing. And just to see that, well, I'm not sure, I don't think I can elaborate on everything they've said during the dinner, but they elaborated on some companies and what would happen with the CFO and so on. And then it turned out exactly like they said 6 months after the conversation. So it's great to see that they are they are very passionate about it and they execute on it. Same story there. The track record is great in general. And the third name I would give is one that is a bit less well known, I think, but it's Francois Rochon from Giverny Capital.
Mhm.
Not sure whether you guys already heard from him.
Oh, yeah.
Yeah,
Yeah.
I think. So it's great to hear that I made some friends and you guys know him as well. So he lives in Canada. He runs his fund, well, since the late 90s. And his track record is also amazing. I would highly encourage everyone to just go to the website of Giverny Capital and download and read some of their annual letters because they are amazing. And one thing, what they all have in common, like Buffett, like Terry Smith, like Francois Rochon, they all keep things very simple. And that's one thing when I still worked in the industry, noticed everyone tends to sound interesting rather than to be interesting, and they make everything way too complex. You have Excel sheets of 600 rows where you try to calculate the intrinsic value to 2 decimal spaces. But yeah, that's not the smartest thing in investing to do, I think, because the more assumptions you make, the more likely that you can be wrong. So that's something that's very important. And I would always say, well, in investing, the two most important things are one, well, having great mentors. And the beautiful thing about the world we live in today is that you can just open up your computer, go to the website of Giverny Capital and download all their shareholder letters and learn from some of the best investors in the world. So that's amazing. And the other thing, of course, is reading. So I think everyone probably who is very successful loves to read and reads a lot. That's also, I'm very strict with my time, and every single day I do the same thing in the morning. First, when I work, usually I wake up depending on where I went, but I try to wake up at 5 a.m., grab a coffee, maybe go to the restroom, brush my teeth, and at 5:05 I just read until 7 a.m. So that's why, having set the goal to read 52 books over the next 52 years, that is a goal I set myself, and I think then you try to become some kind of walking library, and it will definitely help you. So I just think something like that is so important to keep learning, keep expanding, keep talking with other investors, and that helps you to stay relevant as an investor and hopefully to make the right decisions.
What's on your bookshelf today? What have you been reading lately that you can share that investors would find interesting?
So that's a great question, and I usually read 3 to 4 books at the same time, to be honest.
Nice.
One book that I was reading this morning that isn't related to investing is I was rereading The 4-Hour Workweek from Tim Ferriss. And what's also funny there is I think I first read the book when I was 16 years old. So that's, for me, that's 12 years ago. And just the way that your mindset shifts and you completely think about certain things you read. I think one of the better investment books I also read this year is from Alex Morris, and he's a great friend as well. So Buffett and Munger Unscripted. So what he did is a bit like Lawrence Cunningham, he took all the shareholder letters from Warren Buffett, but he also structured them by team. So if you want to, for example, know what Buffett and Munger think about capital allocation, it's a certain theme, a certain chapter in the book that you can read and go from there. We are recording a podcast right now. Obviously, I listen to this podcast of a few guys. I think it's excellent. And what also definitely helps is I try to learn from as many great entrepreneurs and businessmen as possible. So you have a podcast also called Founders from David Sandra. And I'm not sure how many episodes he's in, almost 500, but correct me if I'm wrong. And he just does 1 hour per episode discussing a certain book or discussing a certain founder. And you also notice there that a lot of those great entrepreneurs, a lot of those great founders, they possess over the same characteristics. Like they are extremely hardworking. Often they are quite frugal. Their business is their baby. They have been doing and executing on this for 40, 50 years. So that's amazing. You also have a Harvard Business Review study, for example, that says, well, founder-led businesses outperform by 4% per year on average. It's just very straightforward. I think why? Well, Charlie Munger showed me the incentive and I show you the outcome. When you invest alongside with a company where the manager, where the CEO has invested almost all his money in the business, well, just statistically, rationally seen, you dramatically increase your chances that incentives are aligned. And when someone has a net worth of, I'm just making up the numbers here, when someone has a net worth of 5 billion and 4.5 billion is invested in his own company and it's a listed company, it doesn't mean that it will be a great investment over the next 5 years, but it does mean that the CEO will do everything he possibly can to generate as much shareholder value as possible. So I think using those very simple, straightforward criteria or ways of thinking bring you very far on the stock market, because the numbers and the statistics are what they are. 90% of all investors underperform the market. And that's so funny and sad at the same time, because they are very easy, very straightforward strategies that apparently manage to outperform, like the founder-led businesses. Like everyone knows that over the past 100 years, when you just bought the 10% cheapest stock based on the price to earnings ratio, you would have outperformed the market by a very wide margin. So companies with a moat is another example. Companies with a moat outperform by 3 to 4% per year on average. And there are two great things there. One is the magic of compounding. It's like a snowball. When you can outperform for 3 to 4% per year on average for very long periods of time, well, you will probably be among the 1% best investors in the world. And second thing is, nobody seems to be able to outperform. And by just buying the founder-led businesses, for example, apparently you can be among the top 1% of all investors. So that's probably also, that's something sad, it's something funny, but it's something to keep in the back of your mind. And one last thing I will add to that is Charlie Munger, for example, also was a huge fan of checklists. You have an amazing book also, the Checklist Manifesto, for example, and also another great book, The Investment Checklist. So I'm a huge believer in using those checklists to try to be as rational as possible, because human beings, and especially on the stock markets, we are not rational and we are way more emotional than we would dare to admit to ourselves. So trying to minimize that effect is really important, I think.
Yep, totally agree. So how many questions do you have on your checklist?
How many questions do I have? Well, first and foremost, I always analyze a stock using the same 15 questions or the same 15 metrics. Maybe it would take a bit too long to go over all of them, but it's very straightforward. So you look at the business model, you look at the management, you look at the balance sheet, the capital intensity, capital allocation, the growth, the valuation, and so on. But what's also really interesting about using the same framework every single time is that it's way easier to compare certain companies. If I today want to compare, if I want to compare Microsoft with Brown & Brown, for example, an insurance company, that gets a bit hard and it gets a bit tricky. But when you always use the same 15 questions, always use the same metric within those 15 questions, it becomes way easier to compare those kind of companies. So I think that's one of the most important things. And the reason for that is, when I joined the industry in the beginning, when I joined the asset management industry, I was very young, naive, and probably a little bit arrogant, meaning I was a huge Buffett and Munger fan already then. And I knew the numbers. I knew that 90% of all investors underperform the market. But I, as a 22-year-old guy, thought, well, I know the numbers, but I am passionate about investing, and I will be different, and I will show them how it's done. And I found out that in practice, it's way more difficult in practice than in theory, especially because you also have a lot of bureaucratic things playing and so on. And Wall Street in general, they are thinking in quarters and not in quarter decades. And that's also what Jeff Bezos said, for example. Well, if you think with a 7-year mindset or a 10-year mindset, almost nobody does that. And that's a competitive advantage for you, because then you make decisions or you analyze your stocks in another way, and nobody does it that way. So your competition is way weaker. But my aha moment was when I was at the Goldman Sachs headquarters in London, and we were listening to some CEOs talking of listed companies, but there were 1,000 people sitting in the room. And I was very impressed because I was very young, and all those other people, they seemed very professional, very smart, very hardworking, very passionate, and so on. And I was just skimming through the room, and I thought, look, there are 1,000 people sitting here, 1,000 fund managers, professional analysts, and so on. And if you just take the numbers, 900 out of those 1,000 people in this room will work 70 hours a week and underperform the market. And what will make me different? I'm not that smart as all those other people sitting in the room. That was my thinking. And that's literally a question that kept me awake for a few days. Did I make the right career direction? Because when I spent 20, 30 years trying to do this, and then you're not able to outperform the market, what did I do in the end? You spent a lot of time and did a lot of effort to not generate any extra benefits for your clients, basically. And I think the answer I find for myself is indeed use those checklists and use those criteria that tend to outperform in the long term. And my entire investment philosophy is, that's also maybe linked to the quant strategy I built during my thesis at the university. The first thing I do is I take quantitative criteria that have managed or proven that they can outperform the market, like the skin in the game, like companies with a moat outperform by 4% per year on average, companies with a high return on invested capital outperform. And you take all those different criteria, I put them in a stock screener. When I do that, well, usually only 200 companies remain. So worldwide, there are 60,000 listed businesses and only 200 remain. So that means that your criteria are very strict. But I'm quite sure to say that if you just, for example, would create an equal weighted ETF with those 200 names, I would be quite comfortable to say that they will outperform the market eventually. Why? Because I use 7 different criteria that all on its own tend to outperform the market in the long term, and use that as your investable universe. Use those 200 business as your pond to vision. And then, well, I think we can all agree nobody can analyze 60,000 businesses. When it's 200 businesses, it's already way more manageable. And a lot of those companies are very expensively valued, so we also don't want them. And then within those 200 companies, that's where I'm going to analyze everything myself and hopefully pick the right companies for my portfolio, that your own portfolio does better than your investable universe, and your investable universe also does better than the market. So the goal there is, or my goal is to outperform by 3% per year on average in the long term compared to the S&P 500. So hopefully you can achieve that.
So you mentioned return on invested capital. I'm going to take that bait pretty much every day of the week. Obviously, part of high return on invested capital, you also want a good reinvestment runway. Obviously, a million different ways to kind of do that for different companies, but how do you try to think about reinvestment opportunities, and how does that factor in how you look at stocks?
Yeah, it's a very important thing, and it's funny that you asked, because this morning I was writing an article on return on incremental invested capital as well. Maybe I'll come back on that later, but a lot of people know that return on invested capital is really important. So maybe just for people who don't know it yet, return on invested capital means how much money is the company generating with the money that I invest as a shareholder. To do that in practice, if the return on invested capital is 20%, it means that for every $100 you invest, the company is making $20 for you every single year. So it makes sense that the higher this number is, the better. But what's also important, like you mentioned, a high return on invested capital doesn't add a lot of value when the company doesn't have plenty of reinvestment opportunities. So that's really, really important. And the golden goose for investors, and definitely for quality investors, is that when you have a company with a high return on invested capital that can reinvest everything in the business, because that's how compounding machines are created. And then you will notice that the earnings per share and the free cash flow per share will grow at such tremendous rates. And that's a theory. If you look at it in practice, For quality investing, for example, you see that a lot of companies have a high return on invested capital, but after a while, they become so profitable and so mature that they are pouring out so much cash that they just don't know what to do with it. I think a great example is Apple, for example, and some other big tech companies. They are generating so much cash, but they can't reinvest it anymore at the same rates as it used to. For example, if Apple would produce twice as much iPhones next year, well, they won't be able to sell them because it's just too much. And that's when they start to make other capital allocation decisions like dividends, like share buybacks, and so on. One of the few companies I know right now that can almost, or one of the few quality companies that I know that can almost reinvest all free cash flow in organic growth is Dino Polska. It's a Polish grocery store. Same story, where the founder still owns 50% of the shares. They have a standardized store, so every store looks the same, and they are just very simple. They have one strategy, simple stores, and they start in the west of Poland, and they're just gradually expanding to the east of Poland. And right now they are almost there, and then maybe they will go to some neighboring countries and so on. So that's interesting. And something you also noticed, so like I mentioned, it's really hard to find companies with a high return on invested with a high return on invested capital, with plenty of reinvestment opportunities. Where can you find them? Then it's usually with smaller companies. So Warren Buffett always also said, well, go where competition is weak. Well, where's competition weak? In the small and microcap space. Why? Because the institutional investors are just not able to invest there. If I look at myself, when I was involved in the daily management of an equity fund of 200 million USD, it's peanuts from a Wall Street perspective. But even we never looked at companies at a market cap below 10 billion. So just imagine what a fund of JP Morgan or Morgan Stanley would do when they have billions to invest. So then you can also only look at the large caps. So I think a real difference can be made there. Well, I also still promise to come back on the return on incremental invested capital. It's also an important metric to look at. And it just looks at all the additional investments that are made now, that are made this year. How much are they generating for us? It's a bit more complex for investors to calculate, but I would highly recommend everyone to maybe Google it and take a look. If you are just starting out, I would just recommend you look at the evolution of the return on invested capital, because when you see that the return on invested capital is increasing, well, it's an indication that the return on incremental invested capital is also great. And one exercise that we are doing right now is indeed put some color on the investment rate of every company we own. And it's actually quite an easy formula you can use for that. Your reinvestment rate equals your growth rate divided by your return on invested capital. Meaning if your company, for example, wants to grow by 10% this year and they have a return on invested capital of 20%, well, easy, 10% divided by 20% is 50%. It means that they need to reinvest 50% in themselves to grow by 10% this year. And the other 50% they can use to pay down its debt, maybe from M&A or for dividends of share buybacks. But it's a very important metric. And it's funny because I also have quite some friends. I have one friend who isn't working. He's just managing his own money. And he studied for 9 months straight, from 9 a.m. in the morning to 6 p.m. in the evening, just on return on invested capital. So he can tell a lot about the metric.
What's
Sounds
his
like our
name? We
kinda
should
guy.
get him on the show.
Yeah, right.
You should one day. You should.
Yeah. Down.
So how do you think about, like, does return on invested capital, does that play in? Do you look at the WACC or discount rate? So like, does that enter into that equation at all as well?
Yeah, when you talk about a WACC or a weighted average cost of capital, I prefer to keep things simple. So I never calculate a WACC for the companies I'm looking into. And what do I use as a proxy? I just use my required return as a proxy for the WACC. In other words, I use the return I want to generate myself instead of calculating it. So for example, it can be, when you do a reverse DCF, for example, to look at the valuation of a company, I always use a WACC of 10% because I want to return of at least 10% per year to generate, to even consider the company. As a matter of fact, I want it to be a bit higher, 12%, because I mentioned briefly that I want to outperform the market by 3%. So when you think the S&P will do maybe in a little bit an optimistic scenario, 9% per year, then I need to make 12% on my end to make that work. But that's how I use it, because it's just important, and that's maybe also something important to highlight based on what you asked, Dave. Growth only creates value when the return on invested capital is higher than the WACC. So for example, when a company has return on invested capital 5%, and the weighted average cost of capital is 10%, well, the company shouldn't reinvest, because every single dollar they would reinvest in themselves, they would lose money on that. But what you have in quality investing often is take a company like MasterCard and so on. They are so profitable that the return on invested capital is not 5%, not 10%. Usually it's 15%, 20%, or even in extreme situations, it's 50%. But as a rule of thumb, I always use, I seldomly invest in companies where the return on invested capital is below 15%. So you want it to be higher than that. I hope and I think that you don't have too many companies with a WACC over 15%. So when that happens, when you only invest in companies with a return on invested capital over 15%, you should be fine on the WACC part, and reinvestments should generate shareholder value.
Yeah, all makes sense. I think similarly as well. When you look at trying to figure out what kind of growth rate you want to try to project for a company, which obviously has all of its potential pitfalls as well, but are you looking at reinvestment rate? Are you looking at historical top line? Are you looking at all of it? Kind of what are your thoughts around growth?
Yeah, I think when you want to look into the growth or the future growth of a company, it's always better to be conservative and surprise on the upside than the other way around. So it's difficult. Usually, I look at three things in general. First is just very naively the historical growth rate. Did the company, manage to grow at very attractive rates in the past? If that's not the case, I usually don't even consider investing in the companies, because turnarounds seldom turn. So as a quality investor, you don't want to invest in the next big thing, but in companies that have already won. So you want to see companies that have grown very steadily over the past, and obviously also where you expect this to continue to be true in the future. So just looking at the historical growth is very naive, because you can't expect, without doing any research, that it will just continue. But that's also why I look at two other things. And the second part is probably the best one. And that's just if management gives guidance, to me, that's the best metric, especially with quality companies, because they usually have a strong track record. They usually have the same management in place for a very long time. So you want to see at the track record, and you want to see that they set a certain guidance for the business, and that they manage to under-promise and over-deliver every single time. So in practice, that means that every single quarter, every single year, they actually reported higher revenue and higher earnings per share than what they said they would do. So management wants to be conservative, and when the management team, for example, says, this year we want to grow by 14% per year, you can be sure that they think they can achieve that, and that they probably internally think that they can grow by 15 or 16%, for example. So that's something realistic or something interesting to look at. Unfortunately, not every company gives guidance about its growth prospects. So that's sometimes why I always look at the analyst estimates. And today, via the internet, there are plenty of ways to look at it. But what is really important is analysts are way too optimistic, usually. So I would be very cautious with those numbers. And what I do a lot of people will know the concept margin of safety from Benjamin Graham. So for example, he usually meant that for valuation. For example, I want to buy companies at a 30% discount to their price to book value, for example. But I use a margin of safety of 30% on the outlook of analysts. meaning when the analysts expect certain company to grow its EPS by 15% per year, on average over the next 3 years, for example, I use a margin of safety of 30% on that. So 30% of 15% is 4.5%. So then in my own model, I use an expected EPS growth of 10.5%. And then once again, hopefully the analysts are right. And hopefully it's 15% instead of my 10.5%. But it's a surprise I would be willing to take if it's 15 instead of 10%. So I think that's the most important thing. So you look at the historical growth, the guidance of management, and then also a bit of the outlook of analysts. And based on that, then obviously you're trying to make your own estimate about what is a realistic, conservative growth rate for the future.
Is there a floor that you are not willing to go under? So let's say you're looking at a company, let's say in your investable universe, a company comes in at 7.5% is your estimate. Is that too low? And you're like, no, I'm gonna hold out for something different.
Yeah, it's a great question. It's a difficult question. I would say two things. First thing is it's really company specific. For example, when a very predictable, boring company would grow by 7.5% versus when a very aggressive high growth stock would do that. So that's one point. Second point is if you want to generate a return of 12% in the long term, well, in the long term, stock prices always follow the evolution of the intrinsic value. And I use a very simple formula for the intrinsic value. It's just your EPS growth plus the dividend yield. And by the way, that's based on Francois Lachaud from Giverny Capital. So meaning if all the companies in your portfolio have an expected EPS growth of 7.5%, you probably won't get to the 12% because then you would need the dividend yield of 4.5%, which is quite high. So on average, I want them to be higher, or I want an EPS growth of 12%, and then a dividend yield is some extra upside. But it all depends whether you always try to avoid it as a quality investor, but sometimes a company is a little bit cyclical or it faces some issues. And then the big question is, well, is this a temporary issue or is this a structural thing? And that's the main factor to take into account. And every year I do that exercise. And for example, for my portfolio, the expected growth of the intrinsic value until 2027, so over the next 3 years, is 13.8% right now, 13.8%. I'm very happy with that because when that would be true, stock prices should increase by 13.8% per year as well. And I'm happy. But yeah, there are also the future by definition is obviously it's uncertain. So that's also there. You could, for example, use a margin of safety. But attractive growth is definitely something that is interesting. And in the short term, stock prices are driven by sentiment and changes in valuation. And by the long term, it's driven more by the intrinsic value growth and the EPS growth. Because Terry Schmidt has a beautiful quote as well about that. I'm paraphrasing here right now. But he said, well, when you bought the S&P 500 at the lowest valuation level ever, that was just after the great financial depression in the 1930s. And you sold it at the most expensive valuation level ever. That was in 1999, just before the dot-com bubble. That would mean that you would buy it at a price to earnings ratio at 5 times earnings. Just imagine that you could buy the S&P 500 at 5 times earnings. And you sold it at 30 times earnings. Well, that's just times 6 just because of valuation. But even then, all the returns almost all the returns you would have generated over that period from 1930 to 1999, it would be almost everything would be earnings growth and nothing would be because of the times 6 that your valuation went. So short-term valuation is important. Long-term, more the intrinsic value generation is the most important.
Do you have a targeted time frame that you're hoping to hold a stock? I mean, obviously we all want to hold all our stocks forever, but do you have something that you're kind of expecting when you buy a stock?
Yeah, it was Warren Buffett who said, well, the best time to sell a great business is almost never. So I am running Compounding Quality full-time right now since October 2023. And I only sold 2 stocks so far. And selling a stock is not a great sign for me because it's an indication that I made a mistake. So I would seldomly just sell because of valuation concerns. The main reason, and it will be for 95% of the cases where I sell a stock, is just that I made a mistake analyzing the company, or the investment case I made is no longer intact. Meaning I made my investment case and then maybe I thought the company had a competitive advantage, but apparently it doesn't. Or second point, maybe when you bought stock, the company had a strong competitive advantage, but then our world is changing more and more rapidly. Nowadays, it doesn't anymore, just because something changed. And one example I can give there is I sold Text SA. It's a company that probably won't ring a bell. It's a Polish company that's active in live chat solutions. So when you go to a website and you see that live chat pop up, ask you some questions and maybe put you through an assistant, well, that's what I did. And when I bought the company early 2024, I thought it was a great company, very profitable. The founders were still there. It was cheap. It was everything you would have wanted from a quantitative point of view. And I didn't worry too much about AI being a potential issue for them. But then it became more and more clear that it would be an issue for them and it might be a potential threat. And well, one easy rule, and it's once again based on Buffett, is if you don't want to own the stock for 10 years, don't even buy it for the next month, or just don't even be willing to own it over the next minute. For me, for Text SA, I wasn't sure anymore how the company would look like in 10 years from now, just because of everything around AI. So that's when I made a very odd move, because I prefer to be a buy and hold investor. And I sold the stock after 5 months with a loss of 20%. But in hindsight, or at least in hindsight, so far it was a great decision, because since then the stock is down an extra 50%. So yes, when I sell a stock, it's usually an indication that I made a mistake in the first place. So hopefully I don't need to sell too many stocks over the next few months and years.
Hopefully you won't have too many more mistakes. Let's talk about portfolio construction. When you enter a new position, do you have, like, I don't know, air quote rules of how you like to do that? Do you like to go in small and build up? Do you like to go big boy pants and really pile in? What's considered a full position for you? Like, how do you try to think about those kinds of ideas?
Yeah, sure. I'm quite concentrated with compounding quality. So right now we own 16 high quality stocks, and hopefully they will do well. And over the past few, since late 2023, we have basically built up the portfolio. How did I work in practice there? Well, each position got a weight at the beginning between 4 and 6%. So more or less the same. Maybe when I was a little bit less convinced, it would be 4%. When I was very convinced, it's 6%. But more or less the same. And I don't trim my winners. So for example, right now in my portfolio, I have one big winner that's almost up 200%. And as a result, well, obviously, that's the weight of that company today is twice as much as a company that I also bought for 5% that did nowhere, or that went nowhere. But I just prefer to keep owning that company and keep it in my portfolio, because, well, let your winners learn and cut your losses as soon as possible. I think that's a famous statement. And I don't worry about it. Maybe when that specific stock would go up and make up 20, 25, 30% of the portfolio, that's a different story. And then I might consider trimming it. But usually I don't. So that's something I do. So right now I'm fully invested. But I think that's a beautiful thing. And I think I can speak for everyone here. Most of us are still working. You are hopefully generating, when you're working, a bit of income. And just to keep adding to your portfolio every single month, I think that's a great idea. So that's also what I will do with compounding quality right now. Every single month, add to a new stock, or add to an existing stock, and maybe add a new one as well, and do it that way. It also helps because then you don't need to have any timing concerns, because time in the market usually is a fool's game. It's the same for Buffett. Well, he has been born in 1930, if I recall it correctly out of my head. And he has been a net buyer of stocks all his life. And he has been investing, well, he started at 11 years old. He's now 94. So he has been investing for over 80 years. And just buying being a net buyer of stocks every single year is it's never a bad idea. So that's also how I look at it. And the portfolio will probably remain quite concentrated, 15 to 20 companies. Because to be honest, this is my hobby, this is my passion, this is my everything. I'm spending, well, right now when we're recording this podcast, right now it's almost 9 p.m. my time. I started at 5 a.m. And even I have a hard time with those crazy working hours to follow 16 stocks. So I just can't imagine how you could be able to follow 30 or 40 stocks really well and do that. So I prefer to keep concentrated. And once again, as Buffett said, well, I think he said concentration or diversification doesn't make a lot of sense for those who know what they are doing. So my view on that also, as well as the less experienced you are, the more stocks you would need to own, because the more likely also that you would make mistakes. And the more experience you have, well, then probably makes sense to invest more in your best idea than your 30 best idea.
Can you envision at some point reducing your portfolio and having it more concentrated at some point?
It's a great question. It's a difficult question as well. I think if something like that would happen, it will be more something that comes naturally, which I mean just the winners that keep on winning, and maybe some other stocks that won't perform as you expected them to do so, that their stake decreases in your portfolio. So I would see more something like that. And you also see that with a lot of the famous investors, for example, with Guy Spier as well. He invested the majority of his portfolio in Berkshire Hathaway, and you have some other examples as well. So that's something that could happen, but it will be something that comes naturally over time in that case, I guess.
Yeah. Okay. So when you're looking at investing in a company, if you had to put a time limit on it, like how many hours do you think you spend on a company before you decide to pull the trigger on it?
Oh God, that's a difficult
question. I know it's not an easy question to answer, but
so usually when I buy a company, I write a deep dive about it of 60 pages, more or less. And I probably try to read every investment case and every potential interview with management and every potential podcast you can find. So it's a very, very difficult question. My gut feeling would say maybe 60 hours, something like that, before you decide to pull the trigger. And it's also important to highlight about that. That's when it starts. So you research the company for 60 hours, but that's when you bought it for the portfolio, and that's when you keep following up the company. That's when every time there's a new annual report, you read it. Every time there is an earnings call, you listen to the earnings call, or you read the transcript and maybe ask some questions. I think that's a beautiful thing as well. While you are invested, you keep learning. And just imagine when you spend 60 hours researching a stock, and hopefully you keep it in your portfolio for 10 years, and you, in that 10 years, read everything you can possibly find as well. Well, that's when you can become very knowledgeable about a certain company. So that's the goal. So hopefully in 5 years from now and 10 years from now, I know every single investment case or every single company I own right now, even way better than I do today.
Do you find, as you've gone along doing this, that the companies that you feel like you really, really know, like those ones that you spend all that time working on, that maybe you don't have to do as much to maintain the knowledge of it?
Yeah, I think so, because the more you learn, the more you read, you start to see all the connections, and you see, oh, this is happening at company X. So this also means for company Y that it's also relevant, and this and that might happen. But I think, for example, I didn't mention the name when we first talked about it, but my best performing company so far is Kelly Partners Group. And it's like people couldn't see it when they are listening, but I saw that you smiled, Dave. But I said it's almost up 200% in less than 2 years. But I still recall that how I found out about the company, by the way, is that I saw that Lawrence Cunningham was on the board of directors, and Lawrence Cunningham is a phenomenal guy. He wrote an excellent book, Quality Investing. So that's how I got interested in the company. And I still recall that when I found out about the company, I just couldn't get it, meaning everything looks so good. what am I missing here? So it was a Friday night, and usually on a Friday night, my girlfriend, she goes dancing. She has dancing classes from 8 p.m. until 10 p.m. And I noticed that I was listening. I like to work out as well, and I go for running. I was listening to podcasts where Brett Kelly was talking, and I literally couldn't stop. And it's funny because I ended up running my tour twice and running until 11 p.m. and listen to, I don't know, 4 or 5 podcasts with Brett Kelly to just learn about the business. And yet everything sounded so great. I couldn't find anything what's the hidden risk here? And I just couldn't find it. So also that night, well, I returned from my run at 11 p.m. and I just couldn't sleep. I kept looking at the company until 3, 4 a.m. in the morning. And that's when you get so excited about something and you keep looking and keep looking and keep looking about what am I missing here? What am I not seeing that the market does? And you can't find it. Well, those are maybe the ideas that will only come to you hopefully every 5 years, but probably only once every 10 years or something like that. And that's when you need to swing heavily when you think you are right. And those kind of investments, well, they can make a hell of a difference over time. And you only need a few companies that go up 10x or 20x or even 50x during your entire lifetime to have a phenomenal result as an investor during your career.
Yeah, very well said. Okay.
What was it about that company that got you so excited? Like, what was the biggest exciting piece there?
Well, I think just the entire picture, that everything looked so good, and I couldn't find what I was missing. So it was Brett Kelly, who is the CEO and founder, who is completely Buffett obsessed in the positive sense of the word. Every 3 years so far, the company has doubled in terms of revenue. So that's something you don't see that often. By the way, that's also, which we discussed earlier, Kelly Partners Group is a smaller company. So the smaller you are, the easier it is to still grow at attractive rates. The balance sheet was quite nice. It was an excellent capital allocator. You had people like Lawrence Cunningham, who was on the board. You have an excellent book, The Outsiders, from William Thorndike. William Thorndike, then I found out, was also invested in Kelly Partners Group. In the investor presentation, well, Brett Kelly referenced to The Outsiders and the checklist about what an outsider company which characteristics it should have, and what Kelly Partners Group had. So everything looked good there. So to me, it still does. And I think when Brett Kelly keeps executing on what he's saying that he's going to do, well, the future still looks bright too. So I know that when I was talking with Brett Kelly, and it's a few months ago, it's almost a year ago right now, he said, well, I think within the next 10 years, well, the company should be worth at least $3 billion. And the stock already is up by almost 200%. But he said it should be worth $3 billion. The current market cap in Australian dollars is a bit below 500 million. So if you would be correct there, that's still times six. So I would sign for that. But let's see. I think it's always great to have low expectations, and hopefully you can execute, and then we go from there.
That's cool.
Yeah, that's awesome. All right. So my last question: who do you think is going to you need to put your prediction hat on? So you're not going to be held liable for any of this, but who do you think is going to take over the mantle for Buffett and Munger now that they both are kind of stepping away? Well, Charlie's no longer with us, but now that Warren is stepping down, who do you think is going to take that mantle?
Yeah, the short answer, I think nobody. I think Jason Zweig wrote an excellent piece. There's no next Warren Buffett, and I completely agree with him. Well, he was such an exceptional person, and today there are a lot of great investors, a lot of exceptional investors, but nobody is near the level or track record of what Warren Buffett has done. And what we also need to highlight is, you have an excellent book, The Snowball, about Warren Buffett's life. He started investing at age 11, and he will never stop investing until the day that something happens to him. the magic of compounding is exceptional in that case. And almost all Buffett's net worth has been generated after 65th birthday. And it just kept going and going and going and going. And so you need to have luck on so many different aspects. You need to have luck to some extent that you are able to become 94 years old and still don't suffer from something like Alzheimer and so on. You need to have some luck that you didn't make major or large mistakes. Okay, Buffett is very smart. He's one of the best investors in the world. Maybe that's more skill than luck, but there are different favorable aspects. And maybe there is a great investor and you have great investors of 50, 60 years old right now with a great track record. Maybe if they have the quote unquote luck to keep going on for 30 more years, they will talk to him or reference him as next Warren Buffett. But I would encourage everyone, whether it's about investing, whether it's about working out, your personal life, don't compare yourself to someone else. Just compare yourself to the person you were 5 years ago. Don't try to be the next Warren Buffett, but try to become the best possible version of yourself. I think that's a great rule to live by for everyone.
Strongly agree with that. All right. So fantastic conversation, Pieter. Where people obviously will enjoy what we're doing today, where can people learn more about you and what you have going on?
Yeah, always I try to connect with every investor. So still answering. I think today there are 1 million followers on social media, almost 500,000 email subscribers, and I still try to personally answer every single one, which is sometimes a lot of work, but I just because of my sign of appreciation. So probably compounding quality is the best way to do that. The website is compoundingquality.net and compounding quality on X. So I think that's the most favorable thing, and hopefully, thanks to this conversation, some people start investing, or some people start to do quality investing, then the goal would be achieved. So I'm really grateful for you guys having me. I would just say also congratulate you guys with the amazing podcast you built, because this is 100% free. You told me that there are 10,000 listeners. So I think every single 10,000 of them should send you guys a personal email as well, just to thank you, and that they can listen to this many episodes for free. And apologies for your mailbox right now, guys. But
thank you very much, Pieter. That was very, very, very kind of you. Yeah, for sure. It was absolutely our pleasure to have you again. And we always enjoy talking to you. I always learn something new from you, not only from our conversations, but from all the content that you put out there in the world. And you're doing a great service by trying to help educate people and, help them learn how to start to invest. And that's what we're all here for. We're all standing on the shoulder of giants, right?
Exactly. Thank you so much, guys. Have a lovely day, and hopefully until next time.
Yep. Awesome. All right, folks. Well, with that, we'll go ahead and wrap this up. You guys go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.